Sorry, before you begin, when did you send this file?
Why did I send what? Sorry.
When did you send the file that has this question?
Why did I send the file?
When did you send the
When? Don't
file?
worry, let me resend it now to avoid. Well, it was the first class we had that I sent it. The first class we had. I had sent it from the first class we had. Is this Mr. Olabi?
No.
Okay. I guess I know who is talking. I guess I know who is talking. Yeah. So you guys can have access to the material now. Okay, so I'm currently on page 26 on question 6. Page 26, question 6. Okay, let me do the reading. Color PLC is a fast-growing company in
Sorry,
the
sir.
electronics.
Please, I don't know if I'm the only one that is not seeing your screen.
Okay, you can see my screen.
Yes, I can't.
Hey, okay. Let me share. Sorry. Anyway, can you see now?
Yes, I can see it now.
Okay,
Thank you.
okay. All right, so let me do the reading. All right, so question 6. Color PLC is a fast-growing company in the electronics industry, which is investing in a new project. This project has 5-year life and requires the following resources: building machine 1 to 3, stock, debtors. The company already has a building available for the project. This has a market value of 10 million naira now. Now let's pick variables so that will make sense. Variables, let's pick variables. So we have building. There's an asset, building. So the building costs, the realizable value on that building now is 10 million naira. But it says that this has a market value of 10 million naira now. An expected market value of 10 million naira in 5 years. That means this same building in 5 years, it will be 15 million naira. And then the company had intended to lease it to a local hospital for the next 5 years. There is an intention to lease it out, to lease for 1.5 million naira yearly. All right, yearly. What's wrong with my pen? Yearly. Now, the 3 machines would need to be transferred from other activities and have the following values. Machine 1, 2, 3. None of the machines will have any value at the end of 5 years. All right. The new component which is to be produced has the following cost structure: selling price, variable cost, depreciation, interest and capital, head office expense. All right. Sales are expected to reach 46,000 units per annum. Sales per annum. Sales 46,000 units yearly per annum. And then head office cost order overheads will not be affected, except that new administrative staff with salary totaling 600,000. There's a salary need of 600K. All right, to be appointed on a 5-year contract. That means year 1 to 5. There will be salary that will be paid from year 1 to 5. So the company present capital structures as follows: share capital, reserves, and bonds. So they are giving us who can tell me the rest of this capital structure? The rest of this capital structure is to tell us that we may probably calculate WACC. They are giving us the structure so that we'll be able to discern that there is need for competing WACC in this question. At present, the return on the ordinary shares is 25 kobo. All right. So return on ordinary shares 25 kobo. That represents now that return on ordinary shares. I think the question says 10%. I will say that is cost of equity. But they said 25 kobo. What is the return that is going to shareholders? Ordinary shareholders in value. So if it is absolute figure, that is a dividend. If it is a percentage, that is cost of equity. So we say dividend. All right. Dividend is dividend is 0.25 kobo, right? In naira. So now the return on the market is 13%, RM 13%, all right? And the beta factor is 0.9. The return on the company debentures is in the market is 10%. Now, the return on the company debentures, like I say, that is cost of debt, 10%, all right? And the risk-free is 8%. So required, calculate the cost of capital of the company, rounded upwards to the nearest whole number. Now you can see this is an NPV question, but it's sending us back to cost of capital. Number 2, to calculate the net present value of the project. Number 3, to calculate internal rate of return of the project. Note, ignore taxation. All reasonable assumptions should be clearly stated. Now let me say something to you. This is a professional exam. Anything that has to do with finance, and the question says state any assumptions used. Any reasonable assumptions made must be stated. You must not leave that part unattended, because that may carry almost 5 marks or 3 marks of the allocated score for that question. All right. So let me just put my assumptions here. So while I'm using them, I will be stating them out. So the first question says compute the WACC, right, for the company. And the WACC is what? Cost of equity, value of equity, over value of equity plus value of debt, right, plus cost of debt, value of debt, all right, value of equity.
Good evening,
Value
sir. Please make your handwriting be bold. Please.
Okay, don't worry, I'll make it bolder. Okay, so
Let the handwriting be bold. Thank
I'll
you.
make it bolder. All right, noted. So we have cost of equity, value of equity over value of equity plus value of debt, plus cost of debt, value of debt over value of equity plus value of debt, 1 minus T. But the question says something about that. It says, note, ignore taxation. That means this 1 minus T should be removed from the cost of the WACC, right? So what we will do now is that we will say we need to find the cost of equity. Now, how do I know I need to draw this formula and not ash total over market value? Well, you can use ash total over market value. And like I said, if it's more than 3, ash total over market value make it simple, right? And if they are lesser than 3, it's better to just use this one. If it is just 2 rather. So now looking at the question, I can see the capital structure of the company. The company has ordinary shares and they have bond, right? So on dated, which means it is maybe they've not declared the date they will redeem the bond, right? So the formula is quite simple. Let's go. So that means this company only has 2 capital structure, equity and debt. So I need to find cost of equity, value of equity, cost of debt, value of debt, right? So these are the 2 things I'm looking for. All right. So now, how do I find cost of equity? I will take the variables given. I know that to get the cost of equity, I need to have 2 techniques. I can use 2 techniques. I can use dividend valuation method and I can use CAPIM. So from the question, which one is available? Definitely, you will see that they give us, once you are seeing beta, return on market, risk period, you know that something will have to do with CAPIM. So I can say cost of equity can be computed using capping. So now I will now go to my assumption number one. You see that? Assumption number one. All right. Cost of equity was computed using capping. All right. Using capping. Okay. So, and the capping is risk-free plus beta, return on market minus risk-free. Okay. So now the risk-free is 8% plus beta 0.9, return on market is 13 minus risk-free, which is 8. All right. So that should give us 13 minus 8 times 0.9 plus 8. That's 12.5%. 12.5%. So the cost of equity is 12.5%. Okay. Now we now need the value of equity. But don't forget, we prefer market value because since we are using capital, which is a market base, so our value of equity should also be market based. And the formula for market value of equity is market price per share times number of ordinary shares. Now, looking at the question, do we have market price per share? There is no market price per share. The next question we ask ourselves, how do we get market price per share? I can get market price per share if there is anything that has to do with price earning ratio, anything that I will see price, any formula that I will see price, dividend yield. I know I will see that one is DPS over NPS. I can make NPS the subject of the formula. But in this case, there is nothing like PE ratio, neither dividend yield. But I can see dividend, right? And don't forget, I told us that to get market value, market price of a company share, we can use dividend valuation method. So since I see dividend here, so I can test dividend per share over, all right, cost of equity will give me market price per share where there is no growth. All right. If you go through our previous class, of course, you will see there that I mentioned this if there is no growth. And whenever there is growth, it will become DPS, all right, 1 plus G, okay, over market price per share, sorry, over R minus G, all right. This is where there is growth, okay. And the way there's growth, the growth is terminal. I also gave additional formula, okay. So let's proceed. So in this case, there is no growth. So what we do is that there is DPS, and we have also computed the cost of equity. So what we just did say, NPS equals 0.25, all right, over 0.125, which is the dividend of 0.25, okay, dividend of 0.25. Dividend of 0.25 is what I picked, and also the cost of equity of 12.5, and that gives what? That gives 0.25 divided by 0.125. It's everything big like this. So the market price per share is 2 naira, okay? 2 naira. All right, so I've got the market price per share. Now I need number of ordinary shares. Okay? Number of ordinary shares. So from the question, it says ordinary shares of 10 kobo 1,000. So to convert it to naira to shares, I was 1,000 by 0.1, and that gives what 10,000 shares. Okay. So we have MPS, which is 2 times 10,000, and that is what 20,000. All right. So 20,000. All right. So the cost of the value of equity is what 20,000 naira. Okay. So the next thing is to complete the cost of debt. But the person has told us that there is the cost of the company. I mean, they said there's something about cost of the ventures. The question says that the return on companies, the ventures in the market is 10%. So since the ventures is debt and the bond is also debt, I can assume that The cost of the venture is also the cost of debt of the company. And so I will come here as option number 2. All right. The cost of the ventures, or let me just say, the market cost of the ventures is assumed to be the cost of debt. All right. So the remaining thing is what? The value of debt, the VD. Value of debt, all right? So the value of debt in the balance sheet was how much? Is 4,000. So we need the market value, not the balance sheet value. So we know that the value of debt is um, the value of debt is just like we did value of equity to be cost of equity over I mean the value of the dividend per share over cost of equity. We can as well use this guy. Interest 1 minus T over cost of debt. And since the question says we should not tax, 1 minus T goes out. All right, so we have what? Interest over cost of debt. All right, so now if you calculate the interest now, according to the question, it says 12.5% bond. All right, so 12.5% bond. What's the value of bond? The value of bond is 4,000. Now divided by cost of debt 0.1, which is 10%. So this gives us 5,000. All right. So the cost of debt is 5,000. Now we want to compute. We want to compute what? Cost of equity 12.5. Value of equity. So 10. So the work is going to be, what is happening for big like this? Let's continue. So we have the market cost of debt is what? Sorry, the 12.5 times 20,000 divided by 25,000, and this is 5,000, 50,000 divided by 25. That's 2. So that's 12%. All right, the work is 12%. So the next thing is we should calculate part B says compute NPV, net present value. The net present value is NPV, right? So since there is no growth, the first thing I would check if I were you is to check if the cash flows are growing. But in this question, no cash flow is growing except stock and debtors, right? So that means I'm going to use what? Vertical. Since the cash flow is not growing, I will use a vertical format. Okay, and that says year. Okay, cash flow, right? Let me call it item. Cash flow, discounted factor, and PV, right? So the year, we are starting from year zero if you're using this kind of format. And year zero is always year zero is always for initial outlay. Initial outlay. So now we block this place and call it workings. So workings one, initial outlay. So initial outlay. So the initial outlay here, checking this question, we have a building, and the building, when should we recognize the building? The building has almost three issues. It says the value of the building now is 10 million. The value in 5 years is 50 million. The value, but the company has intention to lease it out 1.5 million yearly for 5 years. That means from year 1 to year 5, they want to lease it out. So which one are we going to pick? We're going to pick the intention according to IFRS 5. All right, asset held for sale. So since the company has an intention to lease it out, so that prevails over others. So all these two will not fly, but this will fly. So and the timing is 1.1 year 1 to 5. So we'll not recognize the building cost in year 0. So let's go to machine. The machine in this case has 4 values: book value, economic value, replacement value, and scrap value. So which one should we pick? And I said, once something like this happens, you revert to what is called Deprieval value. Deprieval value. And let me explain the Deprieval value once again. I said the Deprieval value is for compensation test. Compensation test or Deprieval value. So compensation test or Deprieval value says when asset has a lot of costs. All right. So you pick the lower of the lower of one replacement cost excuse me. Just hold on, please. Sorry, I don't know. The thing is, sorry, let me open it again. Okay, so the lower of one replacement cost and realizable value. All right, and the realizable value is the what? The higher of value in use, or we call it economic value, and scrap value. So now, if you want to apply this on this question now, So let's pick machine one. Let's pick machine one. So let's pick this machine, initial outlay. All right. So for number one, we say machine one, machine one. So in this question, machine one, I told you that if you ignore book value, it doesn't make any sense. All right. So book value does not make any sense. So what we reckon with is economic value, replacement, and scrap value. So for machine one, scrap value, between scrap value and economic value, which one is higher? Class.
Economic value.
Economic value is higher. All right. So for machine one, economic value is higher. And then we compare it with replacement cost. Which one is lower? Replacement cost. So machine one, we are choosing what? Replacement cost for machine one. Replacement. Which is 5,000. So for machine two, we compare scrap with economy. Scrap and economy, scrap is higher. So for machine two, so when we compare scrap with economics, scrap is higher because scrap is 2.6, economy is 2.5. So when we now compare 2.6 with replacement 2.8, 2.6 is lower. So we pick scrap value for this guy. Scrap, which is 2.6. So can you guys do the last one, machine three? Somebody should volunteer and do machine three. Somebody should volunteer and do machine three, please.
3,000.
What is it?
3,000.
3,000.
3,000. How did you get 3,000, please?
So we compare the scrap value, that's 2,400 and 3,000. 3,000 is higher.
Okay.
Then we now compare 3,000 and 3,400.
3,000.
So 3,000
Okay.
is lower.
Oh, that's smart. That's smart. So that means this guy is, we compare 2.4 with 3,000. 3,000 is higher. We now compare economy with replacement cost, is still the lower. So we was economy value, which is 3,000. And that is 10,600, 600 naira. So this is the value of the asset as initial outlay in year zero. Year zero. That is initial outlay. 10,600. All right. This calculator is 12%. So this is an outflow, which is 1, and that is 10,600 for year zero. Now, let's check. Is there any cash flow that will occur in year zero again? Now, let's read the question. It says this project has a 5-year life. It requires the following resources. That means all these resources are required now. All right. So building our products, the time that one will come. Machine 1 to 3, we have looked at that. And then stock of materials and debtors, what is the relevance? We know that stock and debtors are current assets. So, and they are rising, all right? So that means this person will give birth to what is called working capital, all right? Working capital. So, for this guy, working capital. So, working capital is current asset minus current liabilities. So, now let's look at this. Is zero, we have stock. Stock was stock and debtors. Stock and debtors, okay? So stock in year zero was 3,000. So we have 3,000, all right? $3,000, and then debtors is 4,000. All right, and the question says that rising to the stock will rise to 5,000 in year 2, not 500. So that 500 is an error. Right, 3,000 now, but it's rising to 5,000 in year 2. That means it's going to jump year 1 and move to year 2 and become 5,000. Okay, and then now a question: it is actually unreasonable that a cost will rise from year 0 and dump to year 2 like that. And then here is where we now want to make another assumption. It is rising to year 5,000 in year 2, but it did not indicate whether it is at the beginning of the year 2 or at the end of year 2. So we can assume that it occurs at the beginning of year 2. And you know in NPV that any cash flow that occurs at the beginning of the year will be treated in the previous year. So we assume that this rises at the beginning of year 2, and so we treat it in year 1. And so we say if this guy is what? Year 1 and not year 2. And then we'll come to our assumption number 3. The current asset is assumed to rise at the beginning of year 2. So it is treated as a year 1 cash flow. All right. So all these assumptions are very important. It's stated there. And this year 2, this debtors 2 will rise to 6,000. So this is 6,000. So we have cancelled year 2. Everything has gone to year 1 from our assumption. So if you add this guy, is what? 7,000. If you add this guy, it is 11,000. Okay. So this is the current asset. All right. Less current liability. In the question, they did not give us current liability, so and that becomes 0, 0. So this will now be our working capital. So okay. So now I'm trying to create space. Okay. Okay. Sorry. Fine. We're good now. All right. So we continue. So the working capital is 7,000 and this guy is 11,000. But note that this thing is growing. This is outflow actually. Outflow. So that means this thing has grown in year 1. So we are going to have changes in working capital. That means this guy is 7,000. And it has grown in year 1 to 11. So 11 minus 7, that is 4,000. They are both outflows, right? So in the last year 5, working capital is going to be recouped here as 11,000 inflow. Working capital has to be recouped in last year as an inflow. So That means we have recognized one in year zero, which is a year zero working capital, workings two, all right, and that is a 7,000. Become back to one. P is of 7,000. So now we see another working capital in year one. Year one changes in working capital. All right, that is a 4,000, and we're going to have discount factor of what? Year one. Okay, so now we now have, let's take again any other cash flow we have used. Okay, we have not touched sales, salary, and then we've used these guys to complete work. Okay, let's go and check the cash flows, the net cash flows for sales and the likes. So workings three. Workings three. So sales revenue. Sales revenue is price times unit. All right. So what is the price according to the question? The price is 500 naira. So the price is 500 naira times quantity. The quantity is what? 46,000. And that is 23,000 naira. All right. So the next one is variable costs. Material 250, labor 100. 50 plus 100 will give us what? 350. So less variable cost 350, all right, times 100, times 46,000 units. That gives 16,100, all right, which is an outflow. Less variable cost. So less salary, because the salary in this question. We check again what else have we not used. We say that we have used this guy, but we have not used salary of 600,000. It's still what? From year one to year five. Everything here is from year one to year five. All right, so we come with salary, less salary. All right, the salary is 600,000. All right. So after salary, what else have we not used? There is another cash flow we talked about, which is this building. We said building, 1.5 million, year 1 to 5, the one we have intention to list out. So we say building. Don't forget, these cash flows are cash flows of year 1 to 5. Everything here, year 1 to 5. So building here is how much? Is 1,500. So 1,500. So outflow. The next thing we do is we net it. If we net it, we're going to be having 4,800. Okay. All right. So we now come here and say 4,000. Sorry. They 1 to 5. Net cash flow 4,800. All right. And then is there another cash flow we have not recognized? Yes. What is that? The recoupment of working capital, workings 2. So year 5, working capital recoupment, and that is 11,000. All right. So let's net everything and see what we get. All right. So let's check. We're almost done. So this is for somebody can give me
year
the figure,
one.
please.
For
What
year
is it?
one,
Yes.
0.0 Rate for year one. The discount factor 0.8929.
0.8893.
929. 890.
For the 1 to 5, 3.6 or 3.604. Exactly.
So if we net it, we're going to be having 2373. That is our what? MPV. All right. So on this note, the project should be accepted. The project should be accepted. All right. The project should be accepted. So the last question says, calculate the internal rate of return. Calculate internal rate of return. So on that note, class, what is already so assignment. Calculate IRR, right, of the project. So now the next question we are going to solve, which is not tonight, is expected net present value question. And from there, we are moving straight up to risk and uncertainty. Risk and uncertainty. And then under this risk and uncertainty, that's what we're looking at: simulation, sensitivity analysis, sensitivity. I write it down so that if you skip any, you tell me. Sensitivity analysis. After that, we look at a decision tree. We also look at capital rationing. We'll look at so all these things we're just solving maybe one question or two questions, one or two questions on each of them. And then the last one here, we're going to look at MIRR, modified internal rate of return. So all these can be taken care of in one class or two classes max. So thank you so much for your time. I will see you in the next class. And I'll also be sending these notes to the class. And once it drops on my Gmail, of course, I'm going to upload it and then forward the link. Thank you for your time once again. Does anybody have a question for me?
No, sir.
I hope you enjoyed the class.
Yes, sir.
Yes, yes, we do.
Okay, thank you so much for your time tonight. I really appreciate that. I'm sorry for coming late because I went to fix my laptop. As you can see, I'm struggling to put some settings. Even if you look at it, you see that the whole atmosphere, the whole dashboard, everything, the color has changed. So I'm still trying to restore back to the one I'm used to. So thank you so much for your time once again. We'll see you next class. Bye for now.